So what do a 100-week delay on an electrical transformer and like an unverified social media post out of Iran have in common?
Well, they're both pushing the global economy to the absolute brink today.
Yeah. Welcome to NovaStream, everybody. If you're watching the 247 feeds surrounding us on the dashboard, you can see those dynamic sparkline charts flashing with live crypto markets, global financial indices, and breaking news updates rolling in literally by the second.
And the sheer volume of capital moving across the board today is just staggering. I mean, you can practically feel the heat coming off the servers.
Oh, for sure.
But while those numbers flash at light speed, the underlying mechanisms driving them are deeply rooted in very physical, real-world constraints.
Yeah, and that's why we're here to extract the highlights of the day for you. We're going to bypass the noise and just look at the gears turning underneath it all. Because today we are tracking a multi-billion-dollar clue hidden inside Apple's Treasury Department, a meme stock desperately trying to buy an internet pioneer just to, save its own life, and the terrifying algorithmic machinery that allows a single rumor to spike global oil prices before a human being can even verify it.
It's wild. We're watching a really profound collision today. Digital speculation is basically slamming face first into harsh physical reality.
Yeah, so let's start with the most glaring example of that collision on the NovaStream dashboard right now, the S&P 500 index. So it's Monday, May 4th, 2026. The numbers for the first quarter are locked in, and S&P 500 profit margins are the richest they've been since 2009.
Which is massive.
Right, we're staring at a 27.1% earnings surge. On paper, that reads like an absolute golden age for the American economy.
Well, it reads like a golden age until you isolate where that money is actually coming from. What's fascinating here is that the performance is dangerously concentrated.
Like incredibly top-heavy.
Yeah, exactly. That 27% surge is almost entirely propelled by just three entities: Alphabet, Amazon, and Meta.
Wow, just the three of them.
Just them. If you pull those specific tech giants out of the equation, the broader market is stagnating. I mean, consumer-facing sectors and the energy sectors, they're buckling under inflation and just completely exhausted consumer spending.
Okay, let's unpack this, because the entire market is being dragged upward by this AI infrastructure boom. But I look at these hyperscalers pouring billions into data centers, and to me, it feels like a city building a massive, state-of-the-art, multi-billion-dollar high-speed rail network.
Right.
They're laying thousands of miles of track, the stations are gorgeous, but nobody has figured out if the passengers are actually going to buy tickets to ride it. Analysts keep bringing up this so-called ROI gap.
Yeah.
Walk us through that. How are these companies spending so much without seeing a real return?
Well, the mechanism is simple, but it's brutal. The hyperscalers, the Amazons, and the Microsofts are spending tens of billions to build the foundational computing power. And then they lease that power to enterprise customers.
Okay.
So a major retailer, or say a logistics company, integrates this AI to streamline their operations. They might automate customer service or optimize the supply chain, which, it gives them a marginal bump in efficiency.
Sure, they save a little time.
Right, but they're paying exorbitant monthly fees for the compute power to run those models. The cost of the AI infrastructure vastly outweighs the money they're saving on efficiency.
Oh, wow.
Yeah, they aren't inventing new revenue streams. They're basically just paying a huge premium to do their old jobs slightly faster.
So they're just bleeding cash to participate in the revolution, which means eventually those enterprise customers are just going to stop paying the premium.
Yeah, and that's why analysts project 2026 is the year we hit this trough of disillusionment. CFOs across the Fortune 500 are going to start demanding actual, measurable financial returns from all these AI investments.
Yeah. When they don't get them.
When those returns fail to materialize, they scale back their cloud contracts. That creates a demand shock that hits the cloud providers, which immediately craters the revenue of the chip makers.
The domino effect.
Exactly. But honestly, the ROI gap isn't even the primary threat here. The true bottleneck is physical infrastructure.
Right, because we treat AI like it's just, magic software floating in the cloud. We forget it requires a staggering amount of raw electricity.
Or it's an energy guzzler.
Yeah. It feels like trying to power a modern metropolis using a single AA battery. The software is ready, but the physical delivery system is just completely inadequate.
Yeah, the scarcity in the tech sector has fundamentally shifted from a shortage of computer chips to a shortage of electrons. The power grids in the US and Europe simply cannot handle the draw of these new gigawatt data centers.
And you can't just flip a switch to upgrade a national power grid, right?
Yeah, not at all. There is currently a lead time of up to 100 weeks just to procure the specialized electrical transformers required to step down the voltage for a data center.
Wait, 100 weeks. That is nearly 2 years of waiting for a metal box before you can even turn the servers on.
Yep. And in the tech industry, a 2-year delay is a death sentence.
So what are they doing in the meantime? Just waiting.
Well, it's a massive macroeconomic risk because these companies aren't just sitting on their hands while they wait. They're financing all this infrastructure with massive debt. You have companies like Oracle and CoreWeave taking on debt loads that are nearing junk bond territory.
Yikes.
Yeah, which means the risk of them defaulting on their loans is becoming so high that traditional conservative institutional investors are backing away. Plus, this massive capital expenditure is actually inflationary, which forces central banks to keep interest rates elevated.
Add in the fact that a GPU depreciates into obsolescence in just a few years, and these companies are just racing against a ticking clock.
Yeah.
But, if we look at the dashboard, Apple is deploying a completely different playbook here. Just days before their new CEO, John Ternus, takes over, Apple officially retired its net cash neutral target. For the viewers who don't spend their mornings reading corporate treasury disclosures, what is the mechanism behind that specific phrase?
So for years, Apple operated under a policy of balancing its massive cash reserves against its debt. If they had excess cash, the mechanism was to return it to shareholders through aggressive stock buybacks or dividends.
Right, giving the money back.
Right. But by officially retiring that mandate, they are legally giving their treasury permission to hoard capital. The timing is glaring. They're trailing in the AI arms race, and they're preparing to launch their new AI features later this year.
So they're gearing up for something big.
Yeah, retiring as policy suggests they are building a war chest for a massive splashy acquisition later this year to close their gap in the AI race.
I mean, why spend billions laying the track and waiting 2 years for a transformer when you can just buy the most successful train on the market once the dust settles? It's the ultimate luxury of having endless liquidity.
It really is.
Now, contrast Apple's position at the top of the food chain with the companies fighting for their very survival on our breaking business news feed. Over the weekend, the Wall Street Journal reported that GameStop is actually putting together an acquisition offer for eBay.
Yeah, and shares for both jumped immediately in extended Friday trading. It's a wildly audacious move for a legacy retailer.
Here's where it gets really interesting, though. It feels like a nostalgic blockbuster video store trying to buy Amazon.
Yep.
GameStop's fundamental business, selling physical video game discs in strip malls, is dying because consumers just download games directly.
Right.
So they are trying to use this whole meme stock phenomenon to swallow a company like eBay that has adapted far better to modern consumer preferences.
That is the core mechanism of a survival play, though. GameStop has a valuation completely untethered from its actual revenue because of its meme stock status. They have retail investors artificially propping up the stock price.
Right.
GameStop's board realizes that inflated equity is a hyper-valuable currency, but it has an expiration date.
Ah, so they're on a timer.
Yeah. If they can execute a stock-for-stock acquisition of eBay, they can trade their inflated, decaying retail shares for a functioning, profitable digital marketplace before gravity finally pulls their valuation back to reality.
Wow. Speaking of gravity, another pioneer whose model just collapsed officially went down this weekend. Spirit Airlines ceased all operations this past Saturday.
Yeah, that was a huge blow.
We're looking at the immediate loss of 17,000 jobs and tens of thousands of disrupted travelers. People love to complain about Spirit, but their presence served a highly specific mechanical function in the aviation economy, didn't it?
It absolutely did. Spirit was the ultimate market regulator for the consumer. As an ultra-low-cost carrier, even though they were already shrinking, surviving 2 bankruptcies in 2 years, their sheer existence forced the major legacy airlines to keep prices low.
Like introducing basic economy fares to compete.
Right. The legacy carriers like Delta and United had to artificially lower their prices on overlapping routes just to prevent Spirit from stealing their market share. With Spirit finally liquidating, that downward pressure completely evaporates.
So the legacy carriers no longer have to compete with the bottom of the barrel, meaning they'll inevitably hike their base fares.
Oh, almost certainly. But the real prize here isn't just absorbing the passengers, it's the physical infrastructure.
The gates.
Yes, the physical assets are invaluable. The other airlines are already circling to absorb Spirit's gates and check-in counters because aviation is constrained by geography. You cannot simply build a new terminal in New York, Vegas, or Fort Lauderdale. The only way to expand in those premium markets is to cannibalize a dying competitor's physical footprint.
The physical infrastructure dictates the revenue again. Let's trace that reality over to the live global asset trackers on NovaStream. We are looking at a highly volatile Monday on the global board, starting with the Forex feed.
Yeah, look at that.
The US dollar to Japanese yen pair is just wild today. Last Thursday, Japan unleashed an estimated 5 trillion yen, which is roughly 31.3 billion US dollars, to artificially prop up their currency.
They stepped into the market the moment the yen weakened past the 160 line of defense against the dollar.
Right.
And Goldman Sachs analysts pointed out that Japan has the firepower with $1.2 trillion in foreign reserves to do this 30 more times.
30 more times. That's insane.
Yeah.
But throwing $31 billion at the global currency market seems like trying to stop the tide with a bucket. And today's Monday, the UK is on a bank holiday, so London's essentially closed. How does that change the mechanics?
It's all about liquidity. Because the UK is on a holiday today, Japanese authorities are shifting their intervention focus from London to the New York session.
Because the market is thinner.
Yes. If you inject $31 billion into a market with low trading volume, your money hits much harder. There are fewer traders taking the opposite side of the bet, so it moves the price of the yen more violently.
Dropping down to the commodities tracker, oil is climbing rapidly this morning, and the catalyst reveals just a terrifying mechanism in modern trading.
Yeah, oil is spiking based entirely on an unverified post on X from an account associated with Iran's Fars news agency. The post claims 2 Iranian missiles struck a U.S. Navy ship in the Strait of Hormuz for supposedly violating security protocols near Jast.
This is a disputed report, totally unverified. How does a single social media rumor instantly alter the price of global energy before a human analyst can even make a phone call to verify the claim?
Natural language processing algorithms. Institutional trading firms deploy bots that constantly scrape social media and news wires for specific keyword clusters.
So no humans are involved at first.
None. When an algorithm detects Strait of Hormuz, missile, and U.S. Navy in the same proximity, it doesn't wait to verify the geopolitical reality. It is programmed to execute massive buy orders for oil futures in milliseconds. The algorithms buy the rumor instantly to hedge against a potential supply shock.
By the time human beings realize the tweet might be fake, the massive influx of automated buy orders has already driven the price of crude oil up.
Exact.
The algorithms shoot first and verify later. Speaking of digital assets, glancing at the live crypto ticker, the markets are absorbing all this macro tension. Monday morning movements. Bitcoin topped the $80,000 mark over the weekend.
Huge milestone.
Yeah, but it pulled back slightly to open today at $78,543.43, so down just 0.1%. Ethereum is actually up 0.3%, opening at $2,322.49.
Crypto is really acting as a real-time barometer for trust in fiat currencies. When investors watch the Japanese government dump $31 billion to manipulate their fiat currency or watch algorithms destabilize oil, decentralized assets see heavy inflows.
Right.
Investors use it as a hedge against central bank manipulation.
Well, we spent the morning analyzing massive global wealth generation, trillion-dollar tech valuations, algorithmic oil trades. I want to pull focus to the breaking news feed and examine how domestic policy is attempting to manage the extreme ends of this wealth spectrum.
It's a huge contrast.
Now, just to be explicitly clear with you listening, NovaStream does not take any political sides here. We are merely reporting on the policy debate unfolding in the source material today.
Right, just looking at the mechanics.
Exactly. Look at the absolute top of the spectrum in California. The California Billionaire Tax Act went active on January 1st, 2026. It imposes a 5% tax on the global assets for residents worth over $1.1 billion. Unsurprisingly, this is sparking an exodus.
Capital is highly fluid. When a state attempts to capture wealth that aggressively, the wealth simply crosses the border. But the true mechanism is in the loopholes.
There's always a loophole.
Always. For the billionaires choosing to stay, financial planners can use loopholes to save them millions, legally bypassing the tax on massive portions of their portfolio.
So the wealth always finds the path of least resistance. But transition to the opposite end of the spectrum, Utah is currently locked in a massive debate over how to fund policies for its most vulnerable citizens.
Yeah, it's a profound struggle. The Utah State Legislature just shelved a Trump-inspired plan championed by Governor Spencer Cox.
Right. The proposal was to move 1,300 homeless people to an accountability center on the edge of Salt Lake City for forced treatment. Why did the state kill a plan backed by their own governor?
It was a collision of staggering financial reality and severe civil liberty concerns.
Break down the why for us.
Well, conservative policymakers are pushing away from housing first toward mandatory treatment for mental illness and addiction. But the campus was killed due to massive costs, $75 million to build and $34 million to run annually.
And the civil liberties backlash was huge, right? Democratic critics called it an internment camp.
Right, the ethical nightmare of forced confinement.
So what does this all mean? The campus is dead. But Utah lawmakers still gave homelessness coordinator Tyler Clancy $45 million via a tobacco tax to target what they call high utilizers.
Yes, the individuals constantly cycling through emergency rooms and jails. So we have new compromises. In Salt Lake City, there's Project Connect, targeting the 50 most frequently arrested individuals with intense, persistent casework.
And on the other side,
The ARCH program is moving 200 people to halfway houses for supportive accountability. Clancy's perspective on all this is, we're trying to say yes, yes, and yes, it's all of the above. They're running voluntary casework parallel to mandatory halfway houses to see what actually works.
it's incredibly tangled. And it really brings us full circle to the sheer scale of the highlights we've pulled from the NovaStream feeds today. From Apple's hidden M&A war chest and GameStop's wild ambitions to the yin's defense and Utah's deeply complex social policy.
Yeah, and if there's a final thought to ponder that connects these seemingly disparate stories today, it's the collision of digital ambition and physical limit.
Well, that's a great way to put it.
Whether it's the AI industry running out of electrical grid capacity and transformers, or policymakers realizing you can't just mandate mental health treatment without physically building and staffing the clinics. Today's news proves that no matter how much money is in the system, we are entirely bound by the limits of our physical infrastructure.
The digital dials on the dashboard can flash as fast as they want, but the car is still made of metal and rubber.
Absolutely.
Thank you so much for hanging out with us today to make sense of the noise. Keep your eyes on those NovaStream 24/7 live feeds for the rest of the day, as these markets are not slowing down anytime soon. We will be right here watching the board with you. Take care, everyone.